Mark Zuckerberg has witnessed the rise and fall of some of the world's most influential tech companies, and he just sounded an alarm that most investors are completely ignoring. A major tech disaster is looming on the horizon, and it's bigger than anyone realizes. For decades, tech has been a story of exponential growth and rapid innovation, but even the most resilient giants have vulnerabilities. Supply chains can snap, chip shortages can snowball, and geopolitical tensions can disrupt production overnight. What Zuckerberg is warning about isn't just a temporary hiccup, it's a structural shock that could ripple across the global economy. Think about it. A single bottleneck in semiconductor production can delay millions of devices, slow down AI deployment, and even stall electric vehicle production. Suddenly, what seemed like steady growth becomes fragile. Consumers feel it first in their wallets: higher prices on gadgets, delayed deliveries, and a shrinking selection of products. Companies feel it in their margins, stock prices, and investor confidence. This is a moment where fear and greed collide. The fear comes from watching uncertainty unfold. What if the companies you've invested in can't adapt fast enough? The greed comes from recognizing opportunities. Those who understand the market dynamics now could position themselves to benefit when the chaos eventually settles. In the next section, we'll step back and look at history, uncovering patterns from past tech shocks that can give us insight into what might happen next, and why this isn't just speculation. I've watched technology evolve for decades, from the early internet boom to the explosive rise of mobile platforms, and every cycle leaves a warning if you're paying attention. Right now, we're standing at a crossroads where history might be repeating itself, but the scale could be unprecedented. A major tech disruption is looming, and the warning signs are all around us. Supply chains are stretched thin, tariffs on critical components are climbing, and geopolitical tensions threaten to fracture the networks that power our modern economy. This is not a small hiccup, it's a potential shockwave that could ripple through every sector connected to technology. Investors, consumers, and companies alike are underestimating the scale of what's coming. Electronics aren't just gadgets anymore, they're integral to almost every industry. When the cost of chips, servers, and smart devices rises, it doesn't stop at the manufacturing floor. It lands directly in the hands of the consumer. This is a story about fragility, escalation, and opportunity. Those who recognize it early may position themselves for outsized gains. Those who ignore it risk being swept up in the fallout. Over the next several minutes, we'll break down why the next tech shock is different, and why the warning signs today mirror some of the most turbulent moments in history. History is not just a collection of dates and numbers, it's a blueprint for understanding the forces that shape markets. In the late 1990s, the dot-com bubble promised unlimited growth, but ended in catastrophic collapses for companies that had no fundamental advantage. Many investors were swept up in the euphoria, blinded by potential gains. Fast forward to 2008, when the financial crisis indirectly shook technology investments. Semiconductor manufacturers, cloud services, and early AI infrastructure experienced abrupt cost pressures. Supply chains faltered. Demand vanished almost overnight for products that had seemed essential only months earlier. Even more recently, semiconductor shortages during 2020-2021 revealed just how vulnerable global production really is. Key components like chips and rare earth materials became scarce, driving up costs for smartphones, PCs, and server farms. Companies scrambled, but the disruption exposed a truth. The modern tech ecosystem depends on fragile, tightly coupled supply networks. Every time we see these disruptions, the pattern is clear. Rising costs strain logistics, and sudden volatility lead to market uncertainty. Investors who recognized the warning signs early navigated the storm more successfully. Those who ignored them faced rapid devaluation. What happened then is a warning for now. We are seeing the same signals in 2025: tariff escalations, corporate cost pressures, and supply chain vulnerabilities. The market is sending a message. The question is whether we are listening. Looking ahead, the tech shock of 2025-2026 is already beginning to take shape. Import tariffs on semiconductors, rare earths, and essential electronics have climbed sharply, increasing costs for manufacturers. Margins are tightening across industries, from consumer electronics to advanced AI server farms. Companies are feeling the pressure. Production costs are rising, inventories are shifting, and strategic decisions must be made quickly to stay competitive. The result: early signs of financial stress in major tech firms, coupled with growing caution from investors. Every quarter without action compounds the risk of an abrupt market adjustment. It's not just about corporate balance sheets. Consumers are starting to feel the strain. The cost of smartphones, laptops, and wearable devices is beginning to rise. When everyday tech products become more expensive, it erodes purchasing power, creating a subtle but significant slowdown in consumer demand. This is a tipping point moment. One misstep, one unforeseen geopolitical move, or one unexpected supply chain breakdown could cascade across the entire market. Those who are paying attention now can anticipate the areas most exposed, while those who ignore it will be caught off guard. The consumer is at the end of the chain, and the effects are tangible. Price increases aren't just numbers on a spreadsheet. They translate into real-world consequences for households. A new laptop costs more, a smart thermostat is suddenly less affordable, and even everyday electronics like headphones and wearables see noticeable inflation. Consumer purchasing power is declining, and that has a feedback loop. Lower discretionary spending means slower sales growth, which in turn pressures companies to cut costs, delay projects, or shift investments. For the individual investor or household, it's a subtle squeeze that can erode wealth quietly but steadily. Repetition here matters. You feel it in every purchase. That's the reality of a disrupted tech economy. Rising tariffs, supply chain bottlenecks, and inflationary pressures combine to make technology both essential and expensive, a paradox that will shape investment decisions for years to come. For investors, recognizing where the pain points are can reveal opportunity. Companies with pricing power, operational flexibility, and strong market moats will navigate this storm. Those reliant on imports or exposed to volatile supply chains will struggle. As we move into the next section, we'll examine the specific corporate pressures that reveal where the real vulnerabilities and potential opportunities lie. From semiconductor giants to retail tech distributors, the ripple effects are only beginning. Now that we understand the historical patterns, early warning signs, and consumer impact, the next step is to dissect corporate cost pressures and market responses. This is where the macro trends meet micro reality and where the real stakes become visible. The first dominoes are falling, and the pressure is coming from multiple directions. Global tech giants, hardware manufacturers, and AI chip producers are feeling an unprecedented squeeze. Rising tariffs on semiconductors, rare earth materials, and electronics are forcing companies to absorb higher production costs or pass them directly to consumers. Take semiconductor manufacturers as an example. The cost of advanced AI chips has climbed by double digits this year, largely due to import tariffs and logistics bottlenecks. For companies reliant on these chips to power servers, data centers, and AI infrastructure, margins are being compressed, forcing some to delay projects or scale back production. Hardware producers face similar problems. Smartphone and wearable device manufacturers are dealing with delayed shipments, port congestion, and rising raw material prices. Inventory management becomes a high-stakes balancing act. Stock too little, and you risk empty shelves during peak demand. Stock too much, and you're holding expensive inventory that could depreciate rapidly. Even tech distributors and cloud service providers are not immune. Contractual obligations, delivery delays, and rising operational costs threaten profitability and investor confidence alike. Every announcement of a production slowdown triggers a ripple in the market. Stock prices react, volatility spikes, and investors scramble to reassess risk exposure. These pressures are compounded by the global nature of technology supply chains. Companies that once relied on predictable manufacturing hubs now face uncertainty from political tensions, natural disasters, and regulatory interventions. The result is a cascading stress test for the entire sector. The consequences of corporate stress do not stop at the production floor. Hardware shortages ripple downstream into multiple industries, creating shocks for both established and emerging markets. Electric vehicle production, consumer electronics, and smart home devices are all experiencing delays, causing price spikes that consumers notice almost immediately. Inventory front-running has emerged as a dangerous trend. Companies anticipating shortages over-order components, leading to temporary oversupply, then sudden shortages, which drives prices even higher. This volatility feeds investor anxiety and consumer frustration simultaneously, a perfect storm of fear and greed. Consider the electronics to automotive chain. AI chips and specialized semiconductors are critical to EVs, autonomous vehicles, and connected cars. Shortages in these components delay vehicle production, affect dealer inventories, and ultimately depress consumer spending. Price spikes appear in markets that had no direct exposure to tariffs, showing just how interconnected the modern economy truly is. Even retail giants are impacted. Stores like Walmart, Target, and Best Buy are forced to adjust pricing strategies as product costs rise. Consumers notice margins shrink and uncertainty grows. Companies that have relied heavily on imports face existential threats if the disruption continues. While domestic producers and steel suppliers may see unexpected gains, creating a stark winners versus losers dynamic. Fear drives panic ordering. Greed drives speculation in sectors that appear insulated but may not be. The interplay of these forces intensifies market volatility, making it harder for investors and companies to make rational decisions. It doesn't end with domestic tariffs and production issues. Retaliation from other countries amplifies the disruption. Export restrictions, counter tariffs, and trade sanctions are already beginning to affect international supply chains. Countries that are key exporters of semiconductors, rare earth metals, and other critical components may restrict shipments to protect domestic interests. This global tit-for-tat creates uncertainty not only for corporations but also for investors. Markets react to speculation, fear, and potential policy changes, often before actual consequences materialize. Stock market volatility increases, and risk premiums for tech investments rise sharply. The destabilization is systemic. An AI server shortage in one country can delay cloud deployments globally. Semiconductor bottlenecks in Asia can stall production in North America and Europe simultaneously. Investors, managers, and consumers all feel the pressure, but the companies with diversified supply chains, strong cash reserves, and pricing power are the ones most likely to navigate this safely. History shows that global retaliation cycles can be slow to resolve, sometimes taking months or even years. Investors who fail to anticipate these cycles risk heavy losses, while those who understand the mechanics can find opportunity. Overlaying the corporate and global pressures is a layer of legal and regulatory uncertainty. Trade laws, intellectual property controls, and international agreements are all in flux. Compliance with the International Emergency Economic Powers Act, export controls, and other regulations introduces operational risk for manufacturers and distributors alike. Legal uncertainty often triggers investor caution. Even if a company is fundamentally strong, litigation risk or sudden regulatory shifts can impact stock performance dramatically. Markets do not wait for certainty, they react in advance, pricing in risk, which increases volatility. For investors and corporate strategists, understanding the interplay of tariffs, legal constraints, and global politics is critical. Risk is no longer confined to the balance sheet. It now extends to policy decisions and geopolitical developments. With corporate stress, supply chain disruptions, and global retaliation outlined, the next chapter will examine consumer behavior, pricing power, and market psychology. This is where the consequences of corporate and global pressures manifest in the real economy, revealing who will thrive, who will struggle, and where opportunities lie for strategic investors. The tech markets are moving in waves of fear and greed, and volatility has returned with a vengeance. Nasdaq indices and tech-focused ETFs are swinging dramatically on any hint of policy change or corporate earnings reports. Hedge funds are adjusting positions aggressively, using options and derivatives to hedge against potential shocks, while retail investors are caught between panic and opportunity. Investor psychology is at the forefront of this crisis. Historical data shows that markets overreact in the short term. In 2000, the dot-com bubble collapsed not solely due to weak fundamentals, but because fear and herd behavior drove selling. Today, similar patterns are emerging. Any minor disruption in the semiconductor supply chain or AI chip availability sends tech stocks tumbling. These swings aren't random. They are amplified by algorithms, margin calls, and the relentless 24-hour news cycle. Price swings can be extreme, often exceeding underlying business risks, which creates both danger and opportunity. Investors who react impulsively risk locking in losses. Those who maintain discipline can exploit mispriced assets. Understanding the mechanics of this volatility is critical. It is not just about short-term fear. It is about identifying which companies are structurally resilient and which are vulnerable to cascading shocks. In other words, volatility itself becomes a tool if approached with knowledge and patience. Not all companies are affected equally. The winners are those with diversified, resilient supply chains and strong pricing power. Domestic tech manufacturers, particularly those with local semiconductor fabrication, have a strategic advantage. Data center providers with proprietary AI infrastructure and long-term service contracts are positioned to benefit as companies scramble for reliable computing resources. On the flip side, import-heavy manufacturers and consumer electronics retailers are at high risk. Tariff escalations, rising component costs, and shipment delays erode margins. Companies without the ability to pass costs to consumers, or without robust cash reserves, are vulnerable to operational and market shocks. This creates a stark dichotomy. Investors must separate short-term noise from long-term fundamentals. Opportunistic capital will flow toward companies with structural advantages, leaving weaker players exposed to market punishment. Understanding this winners versus losers dynamic is essential for anyone positioning capital during this tech disruption. The same logic applies across industries. Retail, automotive, and consumer electronics sectors face systemic pressures, while steel, domestic manufacturing, and logistics companies may experience unexpected gains. Those who see this pattern early can strategically allocate investments to mitigate risk and capture upside. When the headlines scream crisis, the disciplined investor focuses on fundamentals. Companies with sustainable supply chains, pricing power, and ample cash reserves are the safest bets in turbulent times. These are the firms that can weather tariff shocks, navigate geopolitical friction, and maintain operational continuity. Long-term thinking is key. Short-term market swings are often exaggerated by fear and overreaction. Patient investors who focus on intrinsic value and strategic positioning are the ones who ultimately outperform. Avoid chasing hype or overreacting to volatility. Instead, assess which companies have durable competitive advantages and resilient business models. Cash is not just king, it's a moat. Firms with liquidity can invest opportunistically, manage inventory efficiently, and negotiate better terms with suppliers. Pricing power ensures that rising costs don't erode margins entirely, allowing these companies to maintain profitability even during global disruptions. Ultimately, the lesson is simple but profound. Risk is inevitable, but opportunity is hidden within it. Investors who understand supply chain fragility, market psychology, and long-term value creation can navigate this crisis with confidence. Avoid panic, analyze fundamentals, and position for the future rather than react to the present. The signs are clear. A major tech disaster is not a distant possibility. It is a looming reality. Supply chains remain fragile, tariffs continue to escalate, and geopolitical tensions are feeding a cycle of retaliation that directly affects technology production worldwide. Semiconductor shortages, rare earth export restrictions, and rising shipping costs are not isolated issues. They cascade across multiple industries, from consumer electronics to electric vehicles, data centers, and AI infrastructure. Market volatility amplifies the risk. Nasdaq tech indices and ETFs are swinging sharply, reflecting investor fear, overreactions, and algorithm-driven trading. The consequences are not hypothetical. Companies with import-heavy supply chains face profit compression, inventory mismanagement, and operational uncertainty. Consumer purchasing power is eroding as electronics, smart devices, and AI hardware become increasingly expensive. Yet within this crisis lies opportunity. Investors who focus on resilient companies, those with diversified domestic supply chains, pricing power, strong cash reserves, and scalable operations, can navigate these disruptions strategically. Patience, discipline, and an emphasis on long-term fundamentals will separate those who preserve wealth from those who incur unnecessary losses. This is not merely a warning, it is a call to analyze, prepare, and act wisely. Recognize the patterns, understand the stakes, and position for the inevitable market realignment. As we close, it's important to remember that volatility and crisis are not unprecedented in technology markets. History teaches us that every major disruption, from dot-com bubbles to semiconductor shortages, carries both risk and reward. What distinguishes successful investors is patience, clarity, and an unwavering focus on fundamentals. Think strategically. Companies with durable competitive advantages, resilient supply chains, and strong cash positions are your anchors. Avoid panic selling, avoid chasing hype. Long-term thinking, disciplined allocation, and attention to structural advantages will reward those who wait and act judiciously. In times like these, the most profound lesson is simple: crises reveal true value. While headlines scream disaster, thoughtful investors identify opportunity. The key is preparation, patience, and principled decision-making. Remember, wealth is not built in moments of fear. It is preserved and grown by those who see beyond the chaos. Take this insight seriously, apply it carefully, and position yourself to benefit when the dust settles.